Good evening, good afternoon, good morning to everybody out there. I'm not entirely sure who's in what time zone, but welcome anyway to, I guess this is the third evening of the IPF this year. I will not take up any more time at all. I believe I won't even do introductions of the authors and the discussants because my understanding is that their bio sketches are readily available either on the website or have already been distributed. So with that, Sajjid, the only thing I want to say is 35 minutes, hard stop at 35, please.
Thank you very much, Dr. Acharya. I'm just going to share my screen. Does that come through?
Yep.
Excellent. Well, thank you very much, Dr. Acharya, and thank you very much to the organizers of the IPF, Poonam, Karthik, Barry, Shankar. This is joint work with my colleague Toshi Jain, who's also on. And just a big caveat here, these are my personal views in my personal capacity. None of this are the views of the PMEAC or should be attributed thereof. This is very much my own thinking. So the motivation here is quite clear. We're 16 months into the pandemic. And I thought it would be important to take stock of the cumulative impact of the pandemic and more importantly, what it portends for the future. So this paper is not about, the cyclical recovery from the second wave. That's an important question, but not part of this paper. It's not about the pace necessarily of monetary policy normalization or inflation dynamics over the next 3-6 months. Again, important questions, but not part of it. We kind of want to take stock of the bigger picture here. And I think the motivation, as if any was needed, is kind of accentuated by these cross currents that we've seen over the last year. Very sharp contraction in the first quarter of last fiscal. Everyone thought this would be a double-digit contraction for the full year, then a very sharp recovery in the next 3 quarters. The presumption of very strong consumption rebound in some quarters, we were more wary of that. But then when the Jan to March GDP report came out, it was clear consumption was clearly lagging. Lower than expected gross NPAs for the large banks and the large corporates, but juxtaposed with this continued stagnation of real credit growth. Perhaps the biggest surprise is ostensibly very large output gaps, given the near 8% contraction last year, and yet core inflation, however measured, is just very sticky and elevated. And then you've got, of course, very strong export growth, but juxtaposed with rising oil and commodity prices, which create adverse terms of trade pressures for India. So lots of cross currents here. And our sense was we wanted to kind of attack this by seeking to pose and answer 4 questions, kind of starting near and narrow and then broadening out. Question number 1, what are the features that characterized India's economy in the run-up to COVID? Because I think this helps inform both the constraints on the policy response, but also helps us inform, the outlook. The second is, what has the cumulative impact, macro impact of COVID been? We need a framework to understand this. Where are the divergences most visible distributionally? And more importantly, what are the macro implications of a K-shaped recovery? The third, I think, is really the meat and bones of the paper, the third and fourth section. Where is growth likely to come from in the aftermath of the pandemic? And we look at the expenditure side of GDP to try and answer that question, looking at private consumption, private investment, government capex, and exports to say which of these drivers can be expected to fire and which may remain dormant for some period of time. And then the fourth question is the broadest. We have to start thinking about potential output and potential growth post the pandemic, but that's a huge sphere. So we just carve out one slice and try and focus on that. The much ignored total factor productivity. And the question is, what is the role of TFP been in declining growth in recent years? And more important, from a policy perspective, what are the macro determinants, if any, that we can find of TFP growth? So that's the outline. Now, to understand where the economy was before COVID, we have to kind of understand these very different growth eras. So, one can look at the last 20 years and say India is going at about 7%, and that's impressive. But you've had very distinct growth episodes that were driven by different factors that we want to lay out. The 2002 to 2010 period was one which was characterized, India became Asian, as we joke on the title, was characterized by very strong exports growth. This is the time period where India is in a the world is hyper-globalization. India plugs into the global export engine, and exports in real terms are growing at 15% a year for almost a decade. It's the strength of that external demand that drives the domestic private investment cycle. And investment in that time period is growing at 10%. Private consumption very much lags the cycle, growing at less than 7%. So if you look at the share of GDP on the right-hand side chart, what you will see is exports to GDP almost more than double in a decade. Investment to GDP goes up, and private consumption, even though the largest share of GDP, is actually declining every year for a decade. Now, this looks very much like China. If I were to plot the same chart for China, the trajectory of these variables would be the same. The levels in both axes would be noticeably different, but the trajectory is very, very similar. So in a way, this was kind of the Asian style of growth for almost a decade. Of course, we all know that the story then came to an end. Post the global financial crisis, export growth slowed noticeably. We had, overcapacity for investment in some sectors. Corporate leverage went up. We had a lot of stalled projects on the ground and implementation bottlenecks, and all of that made some of investment uneconomic. Arvind, who's here, has spoken, eloquently about the twin balance sheet problem, and here's a manifestation of that. That investment rose, but corporate debt rose as well, and then you had an extended period of deleveraging where the corporate debt had to be brought down, and that weighed heavily on investment. I will come back to this later. And the second element of the twin balance sheet problem is the banking sector. You see on the right-hand side chart, as stressed assets begin to rise year after year, banks retrench, and aggregate real credit growth, choppy as it is, actually comes down. So that's where kind of the first story ends. I think what's less appreciated is that this endogenously triggers a growth pivot. That the banking sector, which is now recognizing and resolving lending to large industry, looks around the economy and says, well, where is the one sector that we can safely lend to? And it's the retail sector, because household debt was quite low 10 years ago. So what you see is a big retail boom. The left-hand side chart, the blue line is the retail real credit. The axis is very long, but we're looking at 10-15% in real terms over 6-7 years. And the NBFC on the right-hand side chart accentuates that. So essentially, you have a system where a financial system is reeling from resolving stressed assets to large corporates who are undergoing deleveraging, looking desperately to see where it can funnel credit. And it funnels credit to households, thereby fueling this consumption boom over the next 5 or 6 years. And so, if you think of this from this is a very different growth story, where consumption now is the leader, not the laggard when it comes to growth. It's driving growth, as you can see in the left-hand side chart. Exports have fallen off sharply. Investment is middling because it's got one driver of growth. And banks are happy to lend to households, and households are happy to have access to institutionalized formal credit. This, in a way, releases liquidity constraints. It enables lifetime consumption smoothing. Essentially, it's just a manifestation of the permanent income hypothesis. Now, this is all well and good if it hadn't been for the fact that under the radar, household income perceptions have actually been falling since 2012. This is from the RBI's Household Urban Survey, but this very much tracks annual disposable income data for households. So perceptions are falling over time for contemporaneous income. Households still remain relatively sanguine about where income will be 1 year ahead. The yellow line is quite flat. The blue line continues to fall. But the more the blue line falls, the more this gulf opens up between spending and income perceptions. Right? So the right-hand side is essentially telling you that over time, this perceived increase in spending over income is rising and rising and rising. And so in a way, what the macro variables on page 10 tell us is, in a way, what we knew, that a lot of this consumption was not being financed by organic income growth, but was being financed by a depletion of household savings for 5 or 6 years and an increase in household debt. We don't have very good data on household debt, so we've had to splice two series, the CIBIL data and the more recent RBI data. And the short point is, this game can't go on forever. There's going to come a point where income expectations, both current and future, will reach a point so as to make households uncomfortable to continue borrowing and spending. And that's what happens in around, end 2017, early 2018. What you see is different variables suggesting that consumption had begun to slow, well before the IL&FS shock. That retail real credit had come down. We look at the consumer goods IIP data, which is high frequency, that had begun to slow. If you look at the household spending perceptions, those perceptions had begun to come down from 2018. The reason this is important is there's an identification problem here. A lot of people will say, well, consumption only suffered because financial conditions really tightened in 2018 after IL&FS. And if that's your hypothesis, then the implication is, well, after the COVID, because financial conditions have eased so much, consumption should pick right up. That's not our hypothesis. What we're trying to show is consumption had begun to slow well before the IL&FS shock in the NBFC sector on incipient balance sheet concerns that households have, because this has an important bearing for consumption growth going forward. Of course, the fact that financial conditions did tighten, you see in the right-hand side chart, spreads tightening around end of 2018, accentuated the consumption slowdown, but I would argue it didn't trigger it. So the first feature really of pre-COVID India was a consumption driving growth in the last 5-6 years, unlike exports and investment in the first cycle, but consumption slowing coming into COVID. The second one I will not spend much time on because this is well known, was this kind of malaise in the banking system, which we all aware of. We just want to show bank credit as a percent of GDP. You had the credit deepening happen, in the 2000s. Since then, the deepening has stalled and in fact even reversed. We know what some of these factors are. The right-hand side chart, I think, is quite revealing that private sector banks have actually, have been growing quite steadily. It's really public sector banks that have been a one-way street here. And one can argue what the reasons are, governance issues, incentive compatibility, capital, a whole variety, high levels of risk aversion. So we know that, there has been this supply side constraint on the banking system. And of course, this is chicken and egg. Is low credit driving low growth, or is it low demand driving low credit? I would argue, given the length of time, a lot of it is risk aversion on the parts of financial system. We wrote a piece about 2 years ago showing that one way to identify this is to look at the transmission of central bank rates to lending rates, and noticeably lower transmission in 2018 and 2019 suggested a great deal of risk aversion. So this is the second feature of pre-COVID India, where you've got a risk-averse financial system, and that risk aversion had got accentuated in the year before COVID. Remember, the Yes Bank resolution happened days before the first lockdown. The third feature, I think, is one that's less appreciated, which is that a lot of government spending actually happened before COVID, right? So if you just look at GDP data on the left-hand side chart, what you will see is if you break it down into public administration, which is a proxy for government spending, and core GVA, which is private sector proxy, you find that a lot of the heavy lifting in the 3 years before was done by public administration. It was growing at 9% over a 5-year period, 11% in the last 3 years. And the year before COVID, government spending was growing at 4 times the pace of the private sector. So in a way, slowing growth coming into the crisis had meant the government was trying to mount a counter-cyclical fiscal response, and that ate up a lot of fiscal space. If you look on the right-hand side chart, you will see that public sector borrowing requirements that we've been writing about were above 9% before COVID, and debt to GDP, which was supposed to be targeted at 60, was in fact rising, above 70% in the years before. So in a way, these are the 3 features that we want to focus on. That consumption had begun to slow before 2018 on incipient balance sheet concerns. Credit to GDP has been sluggish and slowing for a variety of reasons over a number of years. Both of these will have implications for the future. And significant fiscal space had been used before the pandemic, thereby constraining how much space policymakers had in the pandemic year. The second question really is now to kind of think about given what we know coming into COVID, how do we assess the cumulative macroeconomic impact. We need some framework. What does it mean to contract by 7% one year and grow by 9% the next year? And I think the most obvious framework would be to use some counterfactual and to ask ourselves, well, where would the level of GDP have been absent COVID? And so we construct the counterfactual by saying, absent COVID in FY21 and FY22, growth would be close to 6%. 5.8 is what we take, which is the 3-year average before COVID. And then you plot the actual level of GDP. What we use for the rest of this year are consensus forecasts that growth will be about 9.2% this year. And what you find is there's about a 7% shortfall in the level of output by the time this year is over compared to the pre-pandemic path. So in a way, if you think of the pre-pandemic path as being one which is consistent with equilibrating the labor market, the path on which investment decisions were made, the path on which borrowing decisions and debt was incurred, the 7% shortfall is quite meaningful. But again, to be fair, we need to, if you're comparing across countries, we need to normalize this, because one can argue a 6% shortfall for a country whose trend growth is 6% is very different from a 6% shortfall for a country whose trend growth is 2%. So to normalize this across countries, what we do is look at the shortfall in level terms and normalize it by trend growth. The right-hand side charts capture both of these. And what you see is regionally, LATAM is off the charts. Clearly, the pandemic has been handled worst over there, and the shortfall is the greatest. In the lower chart looks at individual countries. Of course, US and China actually have surpassed their pre-pandemic path. Most emerging markets are below. India is one where the loss is relatively large in terms of quarters lost, comparable to Indonesia and Mexico. So I think that's just one way to understand this. Now, a 7% shortfall is consistent with scarring, and we do find evidence of that in the labor market. If you look at the employment population ratio, we look at this because two things have happened. Labor force participation rates have fallen and unemployment has increased. And what we do is collapse both of these things into one dimension, which is your employment to population ratio. The orange dotted line is where we were pre-pandemic. The blue line is where we were post wave 1 and post wave 2. So there are some signs of scarring. That's consistent with the right-hand side chart. Again, nothing new here. Demand for NREGA, which is India's automatic stabilizer. And you see that's been consistently higher than pre-pandemic levels. The second question then is distributional, right? And what you're seeing is divergences across multiple dimensions. Back in January, Toshi and I wrote about this K-shaped recovery. And we're finding this K, and this is not unique to India. I mean, just to be clear, the shortfalls that I spoke about, the aggregate shortfalls in the last chart is, across several emerging markets. This K-shaped recovery is also across several emerging markets and in fact, developed markets. But the K-shaped recovery here really is across factors of production, across firm size, across income decile. I'm going to run through these very quickly. Profits have surged at the expense of wages, the left-hand side chart. These are all listed companies, and you see profits compared to
Sajjid, just to give you a heads up, 15 minutes left.
Okay, so I need to speed it up because I need to get to section 3 and 4. The right-hand side chart is nominal GDP versus profits. If you think of GDP on the income side, which is the sum of profits, wages, and indirect taxes, if listed company profits have grown at 17% in a year in which nominal GDP has contracted 3%, then in fact, what that tells you is by construction, unlisted profits, SME profits, and the wage bill have contracted quite meaningfully. So the profits versus, Dr. Jay, just to be clear, 15 minutes are done. So we have about 20 minutes if we take 35 minutes as the upper bar. Sorry, I think you're on mute.
I think we can cut the difference, but I think you're 20 minutes through. So, but speed it up.
Okay, let's do that. Very, very quickly, large firms versus small firms. Profits for large firms have grown sharply. Profits for small firms have contracted. Similar for salaries and wages. Top 100 firms, wages have gone up. bottom 100. So again, just to show that this divergence is happening across large firms and small firms, it's happening across the income decile. If you think of the top 10% versus the bottom 30%, and you take four-wheeler sales as a proxy for the top 10, four-wheeler sales have grown at 5%. Two-wheeler sales have contracted at 20%, showing you the divergence in consumption patterns at the top and the bottom. I think the more important point is, what are the macro implications of this K-shaped recovery? A, there's an effective transfer of income from the poor to the rich, from the bottom to the top. And this will be demand impeding in the steady state, given that the marginal propensity to consume at the bottom is higher than at the top. Number two, increased profitability of large listed firms is good news for them. It puts them in a better position to invest. When utilization rates recover, it helps their balance sheets. It helps with any residual deleveraging. Of course, the counter here is that to the extent that COVID has dented SME balance sheets, it's SME investment that will come under pressure. As I'll show you in a chart later, that's been the source of decline over the last decade. Number four, to the extent that we've had formalization, activity has gone from the informal to the formal sector, we should expect to see tax collections doing better. We already see that in GST, for example. And number five, to the extent that market share of large firms has increased, this could kind of increase pricing power for firms. I think this is the kind of the main section here. The question is, the growth imperative is just increased because of the scarring. The question is, where is that growth going to come from? C, I, G, or X? And the common presumption is this will come from private consumption and private investment. And we're going to make the argument it will have to come from government capex and exports, not from CNI. Why is that? Well, the same survey I showed you before. Look at this RBI survey post-pandemic. Look at what's happened to household income perceptions, post-pandemic, current, future. Look at spending perceptions, current and future, right? So the balance sheet concerns that I spoke about before are simply going to get accentuated post-pandemic, given the income uncertainty, the job uncertainty, and the scarring that I spoke about. This is going to impact consumption. It already is. The left-hand side chart is where each of these drivers of demand are compared to where they were pre-pandemic. Government consumption is stronger, investments are stronger, exports, I'll show you, are much stronger, private consumption is lagged. Compared to some pre-pandemic path, we're already about 9% below. And again, this should not be a surprise if you look at what the RBI survey says. Discretionary goods are where households do expect to retrench, and you're seeing that in the credit data as well. Now, I don't want to make the case that India's household debt is at dangerous levels. Absolutely not. We're still below the EM average. So there's still runway to do that. But I would argue that until future household income expectations improve, hard to expect, given the income and job uncertainty, that households will be comfortable borrowing and spending. So the income effect, I think, will weigh on them. Of course, there'll be price effects here in the sense that monetary conditions have eased, real lending rates have gone down, and those price effects should boost consumption. Our sense is the income effect for now, at least in the near future, will swamp the price effect. So if C isn't going to fire, what about investment? And I think I want to make the point, Arvind has spoken a lot about how the twin balance sheet was a binding constraint. In my view, at least for large firms, it has now ceased to be one. There has been a fair amount of deleveraging done. You can see this in debt to equity ratios. In the top left-hand side chart, you can see this in corporate debt coming down. In the right-hand side chart, industrial credit has been very weak as firms have been deleveraging. The binding constraint has moved from a balance sheet problem to a demand problem, even before COVID. The left-hand side chart is a utilization rate for manufacturing from the RBI's Abacus survey. Even before the pandemic, utilization for manufacturing had fallen below 70% for 3 consecutive quarters. The first time that's happened since the survey began in 2008. So really, today, the inability or the unwillingness of large firms to invest is not a balance sheet constraint, it's a utilization and demand issue. Which is why the right-hand side chart says that consumption and investment have got stuck in this suboptimal equilibrium, that investment will not pick up until you get demand, but consumption was slowing because there were balance sheet concerns, and you required some exogenous driver to break that cycle. What could that be? Before I go there, just 10 seconds on this chart, we speak a lot about the investment slowing. Really, it's not large corporates over the last 10 years, it's household and SMEs. It fell a lot, those have picked up, but it's really household and SME investment that's fallen. And therefore, what happens to residential real estate and to SME investment going forward will have a key bearing. Public investment has been solid, but not spectacular. So the question is, where will, for some reason, this has got stuck. I'm unable to, oh, sorry. The question is, what will break the cycle? Well, let's look at X and G very quickly. Exports clearly have the potential. Given the massive fiscal stimulus in developed markets, look at the projected growth rates for developed markets, the left-hand side chart, over the next 3 years. Very strong growth that's projected for DM more than EM. And in our 2018 paper, the right-hand side chart finds that India's income elasticities, elasticity of domestic exports to global demand, are very strong. They're less than the earlier period, but 2.4 is very strong. So if you do get very strong global growth, India's exports will stand to benefit. We're already seeing that. Manufacturing exports in level terms are 17, 18% above pre-pandemic levels, and the momentum has been very strong. So one benefit here is that a strong global environment over the next 6 quarters does give some growth tailwinds in the form of exports. Those have begun to play out both in manufacturing and IT. And I think the policy implication is fostering an environment that's conducive to export growth. We know an import tariff is an export tax, so trade openness, integrating into regional global supply chains, and ensuring the real exchange rate does not choke off an export recovery, another finding we had found 3 years ago. But will one demand driver be enough? In our view, it won't be enough to stoke an investment cycle. Exports drove investment in the early 2000s because they were growing at 15% a year for 8 years. What we need is a second demand driver. And in my view, that has to be government capex. Now, this has been the government's strategy over the last year. You've seen since last September, central government capex grow very sharply. And much of the recovery in the Jan to March quarter was government spending, and much of the fixed investment that we saw that quarter, 60% of it was essentially public investment by the center and the states. Now, to be fair, to be sure, this is the government strategy going forward. If you look at the central budget and the state budgets, large increases in capex have been planned, 37% by the states, 30% by the center. It's really important, in my view, that capex get executed to help the growth recovery in the latter half of this year. Remember, the overall fiscal thrust is going to be negative. I want to, in the interest of time, avoid the details. Just look at the last line. Last year, the fiscal thrust was almost plus 5%. This year, it's a contraction of 1.3. That's a 6% swing in a year. Understandable given the elevated levels of deficits and debt, but that just makes it more incumbent that the capex that we have budgeted this year gets spent because of the high multipliers that come with it. Again, what are the policy implications? How do you maintain the fiscal deficit target and borrowing this year and still have your high budgeted capex when your subsidy bill is going higher? I would argue privatization and asset sales target this year are absolutely key. The strategic question is, in the coming years, we have to bring our deficit down. How do you then simultaneously provide a multi-year public investment boost, which along with exports is needed to jumpstart growth? I would argue again, asset sales and asset swap. We saw this carried out in the budget of 21-22, which I think was very laudable. That needs to continue. The finance secretary spoke about reprioritizing expenditure yesterday, and we need tax reform to create the fiscal resources to finance public investment. So the long story short is G and X have to create a growth bridge in India for the next 2 to 3 years until C and I recover. My last section, Dr. Acharya, I have about 6-7 minutes left. We all know about the growth imperative, right? I don't need to say that. But what's less appreciated is there is another pressing macro stability imperative to medium-term growth, and that's debt dynamics, right? So we know debt to GDP is going to be close to 90, and perhaps one of the most important determinants of where debt ends up is the denominator, is nominal GDP growth. So given, this is a race between PD, R, and G, given the level of the primary deficit post-COVID, you need higher G just to make sure debt is sustainable. If nominal GDP at 8%, that's the blue line, debt to GDP keeps rising monotonically. Nominal GDP at 10%, debt to GDP becomes more sustainable. So now there's a clear macro stability imperative for higher trend growth. It's beyond job creation and absolving the scarring. It's now debt sustainability for the first time in a generation. The other real motivation for looking at the supply side and potential growth is core inflation. We've had a large contraction this year. Why has a core inflation actually been so sticky for a year? Is that telling us something about the supply side that we need to understand and address? So with that motivation, my last 5 minutes here is just to look at potential output. We use a canonical Cobb-Douglas model where we kind of decompose GDP into A, K, and LH. Essentially, I'll spare the details. We're trying to decompose potential output into the different drivers, which is the capital stock, human capital and labor force participation, and then this catch-all term called total factor productivity. And we're only going to focus on the last term because the capital stock and investment we've spoken about already earlier, and human capital and labor force participation, these are big, broad issues. What is the impact on education attainment from the pandemic? How is it going to affect human capital? How does it affect labor force participation? That's beyond the purview of this paper. We're going to just focus narrowly on A. And what we find is A, just usual disclaimers, estimating potential output is daunting. Disentangling cyclical from structural shocks is tough. So we only focus on TFP. Now, the approach we follow is similar to Loco and Diop from the IMF in 2009, but with a twist. Because essentially what TFP does is it's a residual. And what we're mindful of is that residual is going to capture a lot of cyclical forces. Because in emerging markets, we don't have good utilization rates for capital, and we don't have utilization rates for labor. So we don't have work week hours. So the TFP that we measure is inevitably going to have a lot of cyclical component to it. And so what Toshi and I have done is try to strip that out. So we control terms of trade, global growth, global exports, real rates, to try and get what we call this adjusted TFP, which is supposed to pick up productivity growth in the economy, allocative efficiency. And what do we find? That there has been a meaningful drop-off in TFP growth from a high of 2006-07 from, it was contributing 4.5 percentage points to potential growth. It's now fallen off by a good 2 percentage points or 2.5 percentage points. The reason this is important is there's been so much focus on declining investment that we sometimes forget that these other drivers of productivity have also contributed to slowing potential. Now, the question is what's driving TFP? And so again, with the disclaimer that there are many drivers to productivity, micro and macro, productivity will get a boost from the technological innovation post-COVID, all of that is known. We're just looking, given this is a policy paper, at what are the macro determinants that we can find that correlate to TFP, and we find 3 determinants: the banking sector, public investment, and trade openness. And I'm going to avoid the details given the interest in time. The public investment is proxied by government capex in real terms. Trade openness, as other papers have done, is proxied by exports and imports, the share of GDP. And the banking sector is proxied by real credit growth. Now, remember, we're already controlling for investment. So none of these variables are picking up demand. What they're picking up is holding investment constant. What is the contribution of these variables to productivity growth or allocative efficiency? And so, I'll skip the empirical issues. A person can look at this and say there are non-stationarity concerns, there are endogeneity issues. We control for non-stationarity by taking changes in variables, which is why the Durbin-Watson is fine. We done an endogeneity test using GMM to find that these variables are not endogenous, which gives us more comfort that these are truly reflecting more than just demand. So my last 3 slides, and I'm going to end there, putting it all together, right? The presumption was coming out of COVID, private consumption and investment will drive growth as the government deficit is consolidated. What we've shown is both private consumption and investment were slowing in going into COVID, given incipient balance sheet concerns and falling utilization rates. The binding constraint on private investment has moved from balance sheets to utilization and demand. The scarring from COVID will only accentuate these demand concerns. Therefore, some exogenous force is required to break this equilibrium between C and I. We think that exogenous force needs to be a combination of strong export growth and public investment. What are the policy implications? A big public investment push financed by asset sales and privatization over the next 2-3 years, fostering a conducive export environment. and banking sector reforms, IBC, for example, to promote the creative destruction, governance issues, privatization that's been spoken about. And these are all complementary. Public investment increases export competitiveness. Asset sales and tax reform finance public investment. Banking reforms will be needed to finance the growth that exports and public investment generate. My very last slide, the good news is, I think the FY22 budget has recognized these issues, made a very encouraging start on public investment, or a privatization of 2 PSUs as a signaling mechanism. I think now execution is really key. Factor market reforms have been much in focus, land, labor, power. The point is, while that's a good medium-term target, there's lots that can be done in the near term as we get there. And my final point is, we all know about the imperative for high growth. But given where debt is and given where balance sheets are, that growth imperative never felt more urgent. But I'll stop with that. Thank you so much for indulging me, Dr. Acharya.
Thank you very much, Sajjid. I must say you've covered an enormous amount of ground in, I guess, somewhere between 30 to 35 minutes. We won't debate exactly what. So I must thank you for sticking to time, given the landscape you went over. Lots of questions come to my mind, but I'm not going to use my chair's prerogative. I'm going to turn to the first discussant at this stage, Mr. Ajit Pai from NITI Aayog. If I may turn you over for the first set of comments, 10 to 12 minutes is what's requested. All yours, Ajit. 10 to 12.
I apologize. I just got knocked off a couple of times because of network issues, but I'm back on. So it's I can begin now.
Please, and 10 to 12 minutes. I'll give you a 3-minute warning.
Okay, I'll just get the. So is that screen visible?
Yeah, it is. Thank you.
So, okay, so thank you so much for that wonderful presentation, and good evening and good morning to everyone. Sajjid, I missed a part of your verbal comments because I was knocked off a couple of times because of a poor connection. But overall, I think, what we found while going through your paper and also listening to you today, there are a lot of things that we are sort of, that I think that there's so much in common between, the way we are thinking about things and the way you presented it, that we would focus on some of the areas where, I think we want to stress a little bit more. So to begin with, the way we see the entire slowdown was largely linked to being a banking sector issue. And the reason why I say that is not that there weren't other things going wrong in the Indian economy, but when you just turn around and you look at the amount of impact on economic growth because of the banking sector itself, if you just do the math on the growth of banking and what the deceleration is, that explains about 4 of the period, just prior, if you look at the past 7 years. And if you look at it from peak to trough, it's actually a 900 basis points impact in growth rate. So I'll just walk you through on the next slide a little bit about how that math roughly works. The other second biggest impact, where there is some overlap with the banking sector and credit, is about the household investment that I think you mentioned, but primarily in real estate. So we're going to show you, that almost all of that drop in household investment was in real estate, and so there's some structural issues in the real estate industry. And a large part of both the banking sector issues, yes, there were sort of, governance issues, all of that. But a large part of what drove the issues in the banking and, what the AQR also revealed is that there are a few industries that got overcapitalized, including steel, power generation, and real estate. And then lastly, I think, as has been rightly pointed out, the Indian system overall, not attributing blame whether to government, private sector, etc., it responded very slowly to greater competition in the global merchandise trade post the global financial crisis. So you'll see that global trade itself as a percent of GDP plateaued back then and started to decline slowly. So there was a peak at the global financial crisis just prior. That was declining. And in that environment, our merchandise exports declined even faster than the world, because we didn't keep pace with remaining competitive, and we'll touch some reasons as to why that could be the case. So lastly, when you're looking at these contributions, we just want to say that if you're taking away these two impacts, even with an overlap between them, between household investment in real estate and also the overall financial sector issue, particularly banking, you can see that the Indian economy would have been growing in double digits if it wasn't for these two. So this slide, if you have a look at it, it shows the green, which isn't visible much too clearly. Those columns, they're actually the absolute number of amount of credit from the banks outstanding, the scheduled commercial banks. And you can see that the peak growth rate, which was towards the end of 2010 at 24% of this, declined all the way down to 4.4% in early 17, started to reaccelerate, and then decelerated again even prior to the pandemic. And this, of course, the later bit, you could say, was catalyzed by the IL&FS, some of the NBFC issues. But I think those were more the last straw. There were some structural issues. There's a change in the way people were thinking about things. But the way we would sort of quantify the impact of this on overall economic growth is very roughly the overall scheduled commercial bank's total amount of credit outstanding is roughly about half of the size of GDP, the estimated size of GDP. So if it's growing faster than GDP, it typically be accretive to GDP growth. If it's growing slower than GDP at any point of time, it would be dilutive to GDP growth, it would be a drag on GDP growth. And since the quantum is half, what you can say is that the difference between nominal GDP growth and what the greater growth is would be the amount of acceleration and amount of deceleration provided by the banking credit growth itself. That's sort of the rough numbers. So when you have something like a downdraft of almost 20%, that would be about a 10% relative downdraft. When you're going from peak to trough in growth rates driven by the banking sector. So it was a very material deceleration given the size of the banking sector and the size of the numbers involved over here. This slide sort of shows the supports your point that it was the household sector that drove most of the slowdown all the way to fiscal year 16. But you can see that a huge chunk of that, 550 basis points or higher, was due to basically the dwellings, other buildings and structures, the investment by the household sector in these areas. So the real estate sector, which was quite a bubble, just prior to this period, was one that...
Okay, your chart hadn't come on. So maybe you want to just repeat that, please? It's just come on, the second chart.
Okay, sorry about that. So when we have a look at the chart on top, it shows that the household sector was the one that drove a very significant decline. So almost over 600 basis points of a slowdown in annual GDP. So that translates to growth in that particular year was driving a lot of that downdraft. But when you move further down and we see what the component was highly correlated with this, almost the entire sort of decline can be explained by the household sector's investment in real estate fundamentally. So the real estate cleanup of the sector was, similar to the cleanup of banking. It was very necessary, but it had a fairly significant impact on what the growth rates were. Now, there is some overlap between the two. The overlap between the two, between credit and real estate. But given that the number of the mortgage penetration in India is very, very low, we know that a lot of the transactions are happening outside of the banking system as well. So that should be looked at an independent factor as well, which I think was the second largest contributor to the overall slowdown going into the pandemic. And the third, of course, was exports that I think Sajjid has explained quite really well on how that was contributing as well. So then we said that okay, let's look at the scenario of the current scenario and see what's going on currently based on what we are seeing over there and what Sajjid has pointed out. So one is, of course, profits of large corporates are growing faster relative to spending on labor. But this is typical in a nascent and uncertain recovery, as employers, are cautious on the sustainability of the trends that they're seeing. So they're not going to be hiring anytime soon. They're going to be also postponing discretionary expenses. So I wouldn't read too much into this massive increase in early profitability, thinking that that's going to be sustainable or that trajectory would be sustainable. It's not. I would also agree with Sajjid's analysis that the smaller companies would be getting impacted greater, despite them being tighter, etc. Just because of volatility, but also this pandemic has been unique in the fact that it's been impacting geographically and in various locations. Things in some people would have absolutely no ability to do business, whereas the large corporates, being more diversified, would also be less impacted by that. The other thing that I would look at with a little bit of caution is when we're looking at consumption in this particular equation that is being talked about relative to previous economic cycles and even over large periods of time. We'd say that this time there are actually three factors that are responsible for a drop in consumption. So there's no debate about the material drop in consumption. But the three factors would be one, of course, the inability to spend, as no access to liquidity. So people, there is a call now to provide people with money, the bottom 80% or the bottom 40%. But the second is actually caution in the face of uncertainty. And the third would be the mobility and opportunities to consume being restricted, due to the pandemic. So even if you have the money, you have the confidence, you can't go to the store and spend the money, either because the stores aren't allowed to open or you're not allowed to go there to the restaurants and hotels. So there has been this impact. There have been three components to that. And it's very important for us to understand when we're looking at what to do about this current situation on how we deal, if we want to go after consumption, whether we'll be able to do it effectively or not, or there are other things that we should be looking at. So one very evident trend is that this persistent caution is reflected in credit and deposit trends at SCBs. Credit has been growing in mid-single digits, low single digits, and deposits have been growing in double digits. And even Jan Dhan deposits were growing much faster than overall credit, and in high single digits right now. The other thing that I'd point to when we looked at Sajjid's numbers on understanding the employment and his talking about Manrega, etc. It's actually compounded some of those unemployment issues and some of those other numbers because of the government support this time has been meaningful. Manrega has also been supplemented by PDS and free food. There was also, I think, in the first wave you had actual direct transfers to select portions of the bottom of the pyramid. But when you start combining these two, the two of them without any rent to pay for, especially migrant workers, resulted in compensation that was almost equivalent. So this time around, especially going into the May, June, July, this May and June in particular, the amount of workers that have stayed behind in the rural areas because they're getting this pay, which is 200 or 250 rupees a day, but also when you multiply that about 6,000 equivalent, and you're getting food and you have no rent to pay because you're staying and ostensibly you're staying for free when you're back home in the villages, they had very high friction to return. And some of the supply constraints that we are facing today are actually because of enterprises and particularly factories are facing a shortage of workers at the base of the pyramid.
Ajit, 3 more minutes, please.
Yeah, and then there's an overcapitalization headwinds of some industries that are already behind us. Steel and real estate is behind us. Just want to place that in context. Things have stabilized over there, and consumer confidence and consumption will be trailing indicators. So we shouldn't be spending too much time looking at them, because those will start improving only after the economy. So this is just showing the Jan Dhan accounts and the other accounts. So what we're sort of proposing is the financial architecture tweaks that can reduce cost of capital for the Indian economy and actually accelerate credit growth. And the focus should shift from the cheapest form of debt, which is the sovereign, to driving private credit. And one deviation from the point that I think Sajjid's presentation was very focused on, which was government capex. What we would be strongly suggesting instead is rather than looking at government capex, look at public infrastructure, but look at crowding in private investment. Because as Sajjid has rightly pointed out, the corporates have delevered. They have the capacity. The balance sheets of many players are actually much stronger. And the government's debt has ballooned, to the 90% debt to GDP. And that's been a systematic cause. If you look and compare, which I'll just show you on the next slide, you'll see that in India, we have it the other way around. The government debt is very high and the private credit is very low, and that increases the cost of capital for the overall Indian economy very significantly. We have our 10-year is at 6%. China's 10-year that planned it differently is at half that, at 3%. So the other thing that the government can do is provide guarantees where there's market failure rather than assume all of this debt on its own account. So, we are trying to be fiscally conscious, but also looking at the absolute level of government debt. And for example, a first loss guarantee for a limited period on all A and BBB bonds, which are investment grade, even if it's a 10% first loss guarantee, it will almost cover itself, but it would encourage growth in the bond market, the corporate sector and in investments as well. And then focus on investment in infrastructure will create greatest bang for buck with 5 times higher employment elasticity. And given the bank deposit balances and transfers to citizens may not really have that much effect, on increasing or accelerating spending, and restoring confidence to increasing employment would be the way, to look at it. Now, this is a slide that just shows the incremental GDP growth. When you look at it for USA, you look at it for Japan, you look at it for China and India, what you're going to be seeing is that these countries where the leverage is very high, overall global leverage at 370% of GDP. When you look at India, all the incremental debt that you add has very limited impact on increasing the GDP. Whereas when you look at India right now, the translation of increased debt, because it is a capital-starved country, there is a shortage of credit, a significant shortage. Incremental debt in the Indian system actually translates to much higher growth, incremental GDP. So this is an area that also I think we should recognize in terms of how we prioritize, because if the cause was the financial sector, as Sajjid rightly pointed out, we should look at what the cause was even before this, the pandemic. And going forward, if we alleviate some of these, whether that would help. This slide illustrates, the government debt as a percentage of GDP for just 4 economies: India, China, South Korea, and Vietnam. And you can see that India historically has had very high, elevated government debt relative to these countries. And that's how they kept the cost of debt, the sovereign rating, very low. And all private credit is referenced to this. But most of the growth the past several years has been driven by their rise in private debt, earlier private debt, and now the government debt has had to catch up post-world financial crisis, while India has actually been maintaining and pressuring its government debt. And GDP per capita for a large part, in China, for example, has been driven by the rise in debt since the world financial crisis, rather than the other factors that were impacting earlier. A couple of quick points on this total factor productivity, not going necessarily into the classic components, but some of the other sort of inputs that could potentially improve this, quite rapidly. When you're looking at capital plus labor plus know-how, I think one of the most significant factors that has been holding back India's per capita GDP, or even its overall, total factor productivity, has been the issue of scale. And that issue of scale, it's whether it's our agricultural farms across the world have gone from averages of, in North America from, have been becoming larger and larger and more productive. The average size is above 300 hectares and has been going up. In Ukraine and Russia has been going up. In India, it's been shrinking. Similarly, a system has been set up to sort of support the micro and small. And systematically, we have not been recalibrating that as often. Of course, there was one last year, but the effects will take some time. But this factor of relative scale for a global environment and global competition is one that's been impacting our competitiveness across too many sectors to mention. And that's the way we should be thinking about it. If you've got a same size sector as another country, but we have 3,000 players and they have 3, it's very likely that the country with the same size sector with 3 players is going to be not just more profitable, but also far more competitive because of the economies of scale and relative ability to invest in innovation. Massive potential to grow TFP through improvement in logistics and infrastructure, all else being equal. And then massive potential to grow TFP by reducing compliance and regulatory burden. If you reduce this burden, all else being equal, things move faster. What's going to happen in a year happens in 6 months. That's an immediate sort of improvement, both in growth rates as well as in TFP. And India's secular growth rate can accelerate into double digits just by focusing on just credit directed towards investment, just supporting this private credit, and consumption will follow. Will follow that. I mean, I don't have to go through these, but these are the ways the government has been responding to this issue of scale that we are facing as a challenge when you're competing internationally. So just specifically on MSMEs in India, that this redefinition was, an order, much significantly larger, almost an order of magnitude in some cases, which hopefully will provide some cushion because you still have factors like priority sector lending. And then, of course, the what they call production-linked incentives, which are very WTO compatible, but are going to try and bring some scale to key players over here, so that we start, operating not just for the domestic market, reducing pricing, but also being, impacting exports while being WTO by, compliant.
Ajit, I have to invite you to wrap up. Okay, thank you. Thanks a lot, Ajit. Appreciate it. Let me turn to the next discussant, Dr. Song from ADB.
Is that okay now?
Yes, thank you.
Okay, that's great, Shankar. Thank you very much. So at first, I'm really grateful to Poonam and NCAER for inviting me to this prominent forum on Indian economy. And before I start my discussion, I have just a few words about Indian Policy Forum. I arrived in India in 2018, May 2018. Then shortly after that, I joined the IPF 2018 one. So in the past 3 years, I've been joining. This is my fourth IPF. And through this forum, I have learned a lot about India, about the Indian economy. And also I came to know so many new friends. Actually, I met Sajjid in the 2018 my IPF. I remember that was in Imperial Hotel. And you also made a presentation on India's exports, I believe. So that was, I knew you, then we came to each other. Then I always visited you in Mumbai. Then that was before pandemic. I think in 2019, August, I went to Mumbai and I saw you. So that's really a great forum. And I benefited a lot from Indian Policy Forum. And later this year, I'm going to move back to Manila. I finished my assignment here. And hopefully you will keep this virtual form so I can join Indian Policy Forum from afar. So thank you very much. And hopefully I will continue to engage with this forum and learn about the Indian economy and India. Okay, so let's start my discussion. As a discussant, I need to provide certain critical views. Although I agree with Sajjid completely, his narrative. I follow Sajjid's writing quite closely. And to a large extent, actually, Sajjid's view influenced my view about the Indian macroeconomy in the short term. So very quickly, their paper asked 4 questions. And so India has got quite a severe pre-existing conditions and slowdown consumption, credit, shrinking fiscal space before COVID. And then COVID hurt in the economy badly, and you have these scaling effects quite severely. And then the prospects, it seems they are also problematic. Consumption investment are not so ready, and then you have to rely on exports and the government expenditure. And the last question, they do something about the GFP, which means reform is really critical. Sorry. So after I arrived India, actually I started to be quite interested in the India's business cycle, particularly after the MBFC liquidity crunch. That's sort of okay, whether that's cyclical or structural. The slowdown in India growth. So we have to, my colleague at ADB and I have been doing this study about the business cycle analysis. We built upon a series of papers done by Ila and her colleagues at NIPFB. They have been doing quite a few papers in the past. So we try to update their papers, then try to give some views. So this is a so-called deviation cycles. So we look at the level of GDP. Yeah, you do seasonal adjustment, then you apply HP filter, then you can decompose GDP levels into cyclical components and trend components. So then you can apply so-called BBQ approach developed by Harding, my previous colleague in Melbourne, Harding and Pagan. BBQ approach, then you can apply some refined BBQ approach also by utilizing GDP growth rate itself. Then you can date economic business cycles. So the cycles roughly since early 2000, late 1990s, we have about 4 cycles in India. And the latest cycle, the data in this chart are only apply until before the pandemic. And you can continue, and I think the trough probably reached last year when pandemic struck. But among these 4 cycles, roughly actually matched the periods Sajjid discussed in his paper. And then actually we are more interested in the trend, not only the cycles, but the trend, but we can utilize the cycles and to see how trend growth performs during those cycles. So this is the trend component of this GDP. So it's very clear, actually, before the global financial crisis, the trend growth accelerated significantly, reached 8.5% just before the global financial crisis. Then after the global financial crisis, the trend growth started to decelerate, but still maintain quite a high level, above 7%. Then reached about 7% in 2013. Then stayed at that level until 2016, roughly before the demonetization. So roughly India's trend growth was between 7 and 8% for quite a long period, from roughly before the global financial crisis and after the global financial crisis. Then we did have several successive shocks: demonetization, GST introduction, and then following a liquidity crunch by the NBFC. So the trend growth decelerated significantly from about 7%, the latest number before the pandemic. That point was 4.7%, below 5%. So if you look at all these cycles, through those 4 cycles, you look at the trend growth. As I said, before and after the global financial crisis, Indian economy trend growth was quite healthy, between 7 and 8%. Then the latest cycle starting from, so these cycles I look at from trough to trough. So you include upswing phase and downswing phase. So trough to trough. Then from 2014 Q2, then this cycle, the trend growth came down to around 6.5%. And then in this upswing cycle in the earlier period, still the trend growth was still quite high, close to 7. But then the downswing phase of this cycle came down significantly, sharply to about 5%. Then you look at each component. It's very clearly, actually, India's business cycle was driven by investment. In every upswing phases, investment grew fast. Then the downswing growth decelerated sharply. So it was driven by the investment, then exports. I think this story basically corroborates, quite consistent with what Sajjid said and what Ajit said. So investment and exports are driving. But then this downswing phase in the last cycle, and the investment came down really sharply, only 3%. And then exports actually declined. And the imports are highly correlated with investment. And also imports are highly correlated with exports because India imports oil, then to refine crude oil, refined to petroleum products and exports. Oh, so this is the trend, and I think it's pretty much similar to the story told by Sajjid. So trend growth falling since 2009. Actually, consumption growth in this table, consumption growth was quite stable, around 7%. There's a downswing in the downswing phase in the last cycle, come down to below 6%. But overall, consumption growth relatively stable. Government consumption rose modestly, but investment and exports growth fell sharply over those cycles. So definitely we have structural factors behind sharp fall from 2016. The trend growth fell from 7% to even below 5%. I think the story told by Sajjid is consistent here. We had twin balance sheet problems, financial sector issues culminated in the MBC crisis, liquidity crunch in late 2014. And we also had this deglobalization problems, exports decelerated, and the competitiveness stories that told by Ajit. India's exports somehow couldn't compete in the international market. But then this severe downturn in the downswing from 2019 Q1, this is a calendar year Q1, and then until before the pandemic struck, structural factors basically compounded by cyclical issues. So both cyclical and structural led to the severe downturn in that period. And the liquidity crunch led by the NBFC didn't make things better. And I would say liquidity crunch is both cyclical and structural because the structural issues embedded in the financial sector. And then I have a comment on TFP regression. Tonight's Sajjid's presentation actually tried to explain they have already taken care of the cyclical component issues. In the paper, it was not there. But you look at, I copied their chart from the paper itself, not from the presentation. It seems slightly different. It's quite similar to our cycles. So this TFP regression, because it's like more like a detrended GDP growth. If so, it's a very nice story. Economic cycles in India were driven by credit growth, terms of trade, exports, and public investment. But I think Sajjid is taking care of, try to explain more. So hopefully you can explain a little bit more in the paper. And this scaling, in answering question 2 and 3, actually I would like to combine these two questions together. It's not only talking about the scarring, but also about the prospects of the Indian economy. So one is on the supply side. When you discuss the scarring, you mostly focus on the supply side. And then we look at human capital. If you look at production function, human capital is possibly damaged by the pandemic, but probably not so much. Yeah, you might argue education and would have some impact because children couldn't go to schools. There's some losses of learning losses, but they could compensate over time in the next few years over time. And physical capitals might also be damaged a little bit, probably not very much. I don't know, because some business models might have changed. Then certain capitals might be obsolete, then they couldn't provide the services, productive services. But I believe it may not be very much. Then total factor productivity, I believe the K-shaped recovery, I think, has impact on productivity. And rising inequality would have an impact on productivity. So supply side has some damage, but I'm not sure how much would be. Then on the demand side, you look at your question 3, basically demand side. Consumption, balance sheet might be affected. It's more about the structure of the balance sheet. So rich, you said the income transfer from poor to the rich. So that's a structure. So it might have some impact on consumption. Then private investment, the balance sheet actually, corporates have been repaired. And to some extent, actually, banks' balance sheet might also have been repaired. So I'm a bit optimistic that the private investment might pick up, and if the conditions are right, as Ajit said, once the health crisis passes, then the investment can pick up very strongly. Yeah, government expenditure definitely would be supportive. I don't think India would start to consolidate its fiscal rooms shortly. It will come to support. Then global demand, I think we have the same story. It would improve and India would benefit hugely because the US is the largest export market for India, 18% or even 20, even I think close to a quarter of India's exports. So this is the key. So we need to arrest the decline of the trend growth. That's before the pandemic. And there's a possibility trend growth will be further damaged by the pandemic. So coming out of the pandemic, cyclical, definitely we would have an upturn. Yes, because there's no room for you to, there's no no way to go down further, no room to go down further. The only way is go up. So cyclical, definitely there's an upturn. But I think we need to do a structural reform to arrest the decline of the trend growth, then to boost the trend growth. So that's the only way to get India to go back the pre-pandemic growth path. I think all these issues Sajjid and Ajit, they have already covered. I don't want to repeat them. So let me conclude. So probably it's very difficult to, at this stage, to go back to pre-pandemic output path, as Sajjid put. Why? Because actually the time was lost. We lost almost 2 years. In 2 years, you cannot build up a capital stock, human capital, and then the time is lost unless we have a higher trend growth, potential growth. So efforts really are needed to get the trend growth back to the pre-pandemic level of between 6 and 7%. I think we need certain efforts. But further structural reform can boost trend growth back to 7 to 8%. I'm quite optimistic. Indian economy can go back to the trend growth close to 8%. Then the demand, I don't think demand actually is an issue for Indian economy. It's just the purchasing power and the confidence on the economy. And the GDP equal to C plus I plus G plus X, it's an identity. All variables are endogenous. It's just an identity. Then we can go ahead. So I stop here. Thank you very much for this opportunity to participate in IPF. Thank you.
Thank you very much, Dr. Song. I really appreciate your sticking to time. Now, Sajjid, I'm going to bowl you a small googly, which is before I look for questions from the floor, so to speak, I'm going to give you an opportunity to respond to the two discussants, because I think then you can do justice to their comments. And I'll also bowl you a Chinaman, which is use my chair's prerogative to just make 2 or 3 small question come comments for your consideration, and you can take all this together before I go to the floor. My comments are, in your historical story, the sort of 2 actors in the 2016, 2017 kind of period seem to be pretty much totally missing, which were commented on a lot by other commentators looking at the stuff at that time or a couple of years later, namely the impact of demonetization and the transition to GST on consumption, which you note was falling sharply during that period. I mean, beyond 2018, other things kick in like the NBFC stuff and so on. But question as to why is some little Hamlet missing from, or Prince of Denmark missing from the story of Hamlet. Secondly, I think, looking forward, I think this thought came out that both C and I are going to be sort of underpowered for various reasons, which you, I think, lay out quite cogently. But one thought that I found a little bit missing is, the question of risk aversion. I mean, there's a set of risk aversion, which is standard, so to speak, standard economics, if you don't have sales, you don't invest and all that. But the question of worrying about the pandemic, infections, illness, disease, morbidity, possibly death, in our daily lives, at least some of us elder folk, take that quite seriously. And we've lost friends. So that's one reason why we take it seriously. Now, is that a factor at all in the way you look at things? And if so, does it not make the kind of ramping up of vaccination, to the extent it's possible, a significant economic policy tool, quite apart from a health tool? And third and last question I'm going to pose you is, in the story of building up government expenditure, investment expenditure, and so on and so forth, the worries about fiscal deficit are, of course, mentioned in the context of the debt sustainability set of issues. But if one looks at the central bank's response in the last 18 months, at least as I see it, there is essentially indirect financing going on of the centre's fiscal deficit. And at what point should we begin to worry that the observed year-on-year inflation rates above 6% are somehow friction and supply bottleneck related, rather than a problem of perhaps sustained inflation of the kind we saw between 2008 and 2014. Thank you.
Thank you very much, Dr. Acharya. And I want to thank the discussants, Ajit and Dr. Song, for extrememly important, cogent and constructive comments. I'll just take them in reverse order, Dr. Acharya, to start with you. I think your second question is almost tautologically true. And we've written about this. I think the best economic stimulus for India over the next 12 months is vaccination, vaccination, vaccination. I think there's no two ways about it. Because that's kind of so obvious and we know what some of those binding supply constraints are, we didn't address that. And I began by saying, I'm not focusing on the next 6-9 months, but where we will be the morning after. But to the extent that both the points you made, that there is elevated risk aversion of the kind we haven't seen before, that second derivative is very negative, the gap that we will end up with at the end of this year, the 9.2% growth that we imagine, could in fact be lower, will be a function both of the pace of vaccination, whether or not we have another wave, and the levels of risk aversion. And that just means the permanent income loss is therefore higher. And this is a permanent loss because you're permanently below that path. I mean, in rushing through the presentation, I didn't focus about distinguishing levels from growth rates. This all assumes that trend growth goes right back to where the pre-pandemic trends were. If trend growth gets affected, as it will in many emerging markets, then those permanent income losses just get compounded over time. So I couldn't agree more that vaccination is the best stimulus. I think on government expenditure, you're exactly right. There are two constraints here. One is on debt dynamics. The other is on financing, which again, I didn't address given the interest in time and the scope of the paper. But you're exactly right. The fact is, this third trilemma is, between fiscal and monetary is how do you ensure higher public investment, but how do you do so without borrowing, and how do you then also ensure that bond yields remain anchored? Something has to give. And as you rightly pointed out, we've actually seen very large amounts of liquidity being infused. I would simply add that last year's liquidity injection was the upshot of the BOP surplus, a $70 billion BOP surplus that the RBI bought. This year, the liquidity injection has been much more related to government borrowing. And therefore, it's absolutely critical, as you point out, that we get on a fiscal consolidation path, because the sooner we get on that fiscal consolidation path, the more incentive compatible it is for the central bank to begin to normalize and not be faced in this dilemma of, do I inject liquidity and prevent bond yields or do I not? So I think consolidation from next year is important, which is why I was saying that if you need to marry a credible consolidation path with high levels of public investment, you have to do so either by finding other sources of revenue, privatization, tax reform, or by reprioritizing expenditure. To your point on inflation, I think we worry a lot. And that's the reason I had that chart that, the fact is core inflation has been averaging 5% for the last 18, 19 months. Some of it can be explained by, supply shocks and lockdowns. Input costs have surged, inflation expectations have hardened. There are many proximate reasons. But the fact that it's been so sticky for so long, prima facie tells one that perhaps output gaps are not as large as we think. Perhaps pricing power is greater than we think, which then takes us back to the supply side and the need to address that as soon as possible. Your last question, there has, just given the interest of time, I haven't gone through all the shocks that hit the economy, whether it was demonetization, GST, whether it was the terms of trade from oil. We forget, oil added 100 basis points between 2014 and 2016, with oil prices stabilizing that rolled off. So it was just the interest of time that allowed me to address the shocks. Very quickly, 2 minutes on the discussants, very good comments. Ajit, thank you for excellent comments. I agree with largely what you said. And just a couple of clarifications here. The household investment that we talk about is essentially both households and really small SMEs. And so I think there is some combination of both. You're exactly right that it structures. And I think disentangling that will be important. I agree with you also that this profitability, is unsustainable. But the worry is if those go on for a couple of quarters and the element of heightened uncertainty, you could be risking the fallacy of composition that Keynes spoke about. Every firm cuts costs to preserve its profitability, but in so doing, cannibalizes aggregate demand more generally. And as you pointed out, high uncertainty also means that hiring and employment will be an issue, which is what my bigger concern is, that the consumption slowdown is a balance sheet issue. The longer it takes for employment to pick up, for that income and job certainty to return, the longer we could then find risk aversion levels from households as well. But I agree with almost everything you said. Dr. Song, thank you again for excellent comments. Your estimate of trend growth, I was quite intrigued by, because it correlates closely to what we have. It showed about a 4 percentage point decline, and the TFP declines about 2 percentage points. So there's so much focus on factor accumulation, investment rates, labor cost participation, human capital, but almost half that decline, prima facie, can be explained by low TFP growth. And I want to apologize. This TFP is a paper that Toshi and me are writing separately, a deeper dive into TFP. What we presented was just the initial findings, and those findings have evolved since I sent you a copy of the paper. But I'll stop there because I really agree with almost all the things that the discussants constructively offered. So thank you.
Thank you very much, Sajjid. Let me now pick up a couple of questions that I've received from the attendees. One is from Mr. H.K. Pradhan. I'll just read it out, and then, if you can jot down the thrust of it, please, Sajjid. Today, we have the lowest interest rates, lower and harmonized tax rates, lower inflation rates, possibly lower rent levels, higher regulatory compliances, so less frictions, all lead to low-cost structure. No wonder higher corporate profitability. What is holding growth moving beyond the pandemic? That's one question. Second one is from Mr. Agustin Balraj. Maybe true, it will pick up in a few years. I think the reference is to growth. I'm not sure. How are the people who do not have income currently managed during the crisis? Could Dr. Song respond? So this is really for you, Dr. Song. Because it says lie, and I should have realized that. Third one, I think it's for you, Sajjid. So there are really two for you from the ones I can see at the moment. Thanks for the wonderful paper and presentation. Are microfinance institutions going to revise their survival strategies? Is the definition of sustainable finance going to see a significant overhaul? So perhaps first, Sajjid, and then I'll request Dr. Song.
Again, thank you very much for very good questions. I think I'll just take the second one easier. What I do show is that if you look at the financial sector, again, there's the segmentation that you can see. Large institutions who focus on the salaried class to large corporates, their gross NPAs have been lower. But if you look at microfinance institutions, smaller private banks, you'll see that gross NPAs, NBFCs, gross NPAs are meaningfully higher. And frankly, I think on the financial system, we just have to be more patient because there is a lot of regulatory forbearance given to SMEs. And so even though we can say gross NPAs for large corporates is lower, we really won't know the state of SMEs till that forbearance rolls off and we have a better picture of what happens to NPAs. I think on the microfinance, it's clear that to the extent that there's scarring at the bottom of the pyramid, that will be reflected on. And so that's another reason why one tends to believe that those institutions that were catering to the bottom, may worry about asset quality and may also become a little bit more risk averse. To Mr. Pradhan's question, I think that was the purpose of the presentation, that yes, financial conditions are easier. And therefore, I try to distinguish between income effects and price effects, that financial conditions are easier. But we've seen for a while now that even with financial conditions being easier, the banking system has been reluctant to extend its balance sheet, and there's been a lot of risk aversion on there to grow. Instead, it's been buying a lot of government bonds. And on the demand side, what I was trying to lay out is it's a bit of a chicken and egg problem, because households at this point have a balance sheet concern that they worry about, an income effect that could swamp the price effect. To the extent that there's some hysteresis from this, the balance sheet concerns could get more accentuated. And without a visible sign of demand, hard to see large corporates investing. Utilization rates are in the mid-60s. So it's this kind of vicious cycle of C&I that we saw in the 3 quarters before COVID that I worry about, which is why I think you need some exogenous driver to break the cycle in the form of exports and public investment.
Thank you. Thank you very much, Sajjid. Dr. Song, do you want me to read out the question again, or are you okay with it?
Yeah, I think I have a look at the question. I think the question is about income growth might come back in the next few years, but during which period the growth didn't pick up, people might not have income. Then how do they go without income? I think this is the question. I think this is the role of the government. So Indian government has done quite a good job, in my view. Last year, the economy contracted by 7.3%. Then the fiscal deficit of the union government was 9.2%. So this is how the government support. And the government put a lot of measures to support the vulnerable groups, social protection measures, free grain, free gas, so a lot of things. I think this is how the government helped people with much less income during the crisis. I think I'll stop here. Thank you.
Thank you very much, Dr. Song. Now, Poonam, I'm an old finance ministry hand, and we always believed in the elusive fiscal surplus, which we never got, of course. But I like to think that if you ask me to chair a session, I'll deliver you a surplus of, even if it's 2 minutes or 1.5 minutes. So I'm going to turn it over to you for the next session. And before I do that, I want to thank you, Sajjid, for a wonderful paper. Really excellent. You covered a lot of ground and you did it with a lot of credibility and analysis. So thank you very much. I also want to thank both discussants for their terrific comments, and also to those who offered questions from the floor.